What's the difference between trading and investing? Imagine two people. Both start with $10,000. 10 years later, one person has built real wealth. The other spent years chasing stock prices and barely got ahead. So what happened? Were they smarter? Luckier? Not really. The difference came down to one simple choice: trading or investing. And understanding this difference could save you years of mistakes. Most people think trading and investing are the same thing. After all, both involve putting money into stocks. But that's like saying a sprinter and a marathon runner are the same because they both run. The goal is different. The strategy is different. And the results can be very different. So let's break it down. First, let's talk about trading. Trading is all about making money from short-term price movements. A trader buys a stock expecting its price to go up soon, then sells it for a profit, sometimes within days, sometimes within hours, and sometimes within minutes. Traders don't necessarily care about the company itself. They care about the price. They're constantly looking at charts, market trends, and breaking news, trying to answer one question: will this stock go up next? And if they're right, they make money. If they're wrong, they lose money. The problem is, predicting short-term market movements is extremely difficult. Even professional traders struggle to do it consistently. Now let's talk about investing. Investing takes a completely different approach. Instead of asking what will happen tomorrow, investors ask what will happen in the next 5, 10, or even 20 years. An investor buys shares of a company because they believe the business will grow over time. They're not worried about daily market fluctuations. They're focused on long-term growth. And this is where something powerful happens. Compound growth. Your money earns returns. Then those returns start earning returns too. Over time, this creates a snowball effect, and that snowball can become enormous. Now here's the real difference. A trader focuses on timing the market. An investor focuses on time in the market. Read that again. A trader focuses on timing the market. An investor focuses on time in the market. And that small difference changes everything, because nobody can consistently predict what the market will do tomorrow. But history has shown that patient investors are often rewarded over the long run. Let's look at a simple example. Imagine two friends, Jake and Michael. Both start with $10,000. Jake becomes a trader. Every day he's checking stock prices, watching financial news, looking for the next big opportunity. Michael becomes an investor. He puts his money into quality investments and leaves them alone. 1 year passes. Jake has some wins and some losses. Michael's portfolio grows steadily. 5 years pass. Jake is still searching for the next hot stock. Michael's investments continue compounding. 10 years later. Michael's biggest advantage wasn't intelligence. It wasn't luck. It was patience. This is one reason why Warren Buffett became one of the richest investors in history. He didn't build his fortune by constantly buying and selling stocks. He focused on owning great businesses for long periods of time. In fact, Buffett once said, "If you wouldn't own a stock for 10 years, don't think about owning it for 10 minutes." And that idea perfectly captures the difference between trading and investing. So, what have we learned? Trading is about short-term price movements. Investing is about long-term wealth creation. Trading can create fast profits, but it comes with higher risk and requires significant time and skill. Investing may seem slower, but for most people, it's one of the most reliable ways to build wealth over time. Because in the market, the biggest winners usually aren't the fastest, they're the most patient. If you enjoyed this video, subscribe to Cashverse for more simple explanations about money, investing, and wealth. And remember, don't just make money. Learn how money works.